Okay, so good evening, class, and welcome to the advanced tax class for this evening. We are going to be doing one course called Taxation of Business Income, Double Taxation Relief. Now, double taxation relief is the kind of tax that you enjoy a kind of relief because you earn foreign income. It's a kind of tax whereby a Nigerian company earns foreign income. When we say a Nigerian company, we mean a company that is incorporated in Nigeria. So any company incorporated in Nigeria is a Nigerian company. So whenever a Nigerian company earns foreign income, it means that that Nigerian company is situated outside of Nigeria. Primarily, it is domiciled outside of Nigeria and is earning foreign income. So can we think of any company that is Nigerian and earning foreign income? Okay, let me give you an example. Let's assume, for the sake of this illustration, that Glo Nigeria decides to set up Glo Ghana or Glo South Africa. Now, it means that it will be earning foreign income, a currency and income different from that earned in Nigeria. Now, this company qualifies for double taxation relief. Now, if we talk about MTN, that is not domiciled, that is not registered in Nigeria, Now, if MTN registered in South Africa but earns income in Nigeria, there is a different thing we do about it. We use the special business model to attack that, because that's a foreign communication company that is earning Nigerian income. The reason why we are doing it is that once a company is incorporated, the land where it is incorporated, that is where it is paying or channeling or repatriating its tax to. And so if Glo, registered in Nigeria, has branches in all African countries and some parts of the world, the worldwide income of Glo will be repatriated to Nigeria. After all, Glo Nigeria is going to do the consolidated account that will consolidate everything. And so it's going to consolidate everything it gets from all over the world. That being said, if MTN is also giving its own account, it is going to consolidate everything it's making and send to South Africa. And so the only tax that MTN will suffer in Nigeria is the one that they derive from Nigeria. And coming back to Glo, the only tax that Glo will suffer from South Africa is the one they did in South African soil. Now, when they now suffer tax from South African soil, they bring it to Nigeria, they are still going to suffer another tax for bringing it to Nigeria. Hence the name double tax. And so, is it a crime that they are earning foreign income? Why would they be taxed twice? And so that gives rise to what is called the relief or the tax credit that they enjoy because of earning foreign income. And now there are some principles you should know about double taxation. Later on after the class, I will send a voice note that explains again double taxation. I believe you enjoyed the other voice note that was sent about capital allowance and basis period. Okay, now in double taxation agreement, there are two categories. One, when double taxation agreement exists. Now, I want you to look at it this way. If there are two people coming to do a partnership business and there are partnership agreements, deeds of partnership agreements spelling out everything that they will do. You know, the partnership will abide by that set of instruction. And so if we bring it down this way, if double taxation agreement exists, they are going to bind themselves with that agreement. And so what happens is this: whenever there is a tax, mind you, it's a Nigerian company registered in Nigeria but domiciled outside. Whenever that Nigerian company gets taxed outside and brings it back to Nigeria, if there is a double taxation agreement, what Nigerian government will do is to compare the tax rates of the foreign company or the foreign country where it is domiciled with the tax rate of Nigeria. Whichever is the smallest, that is the rate that will be used to charge the income of the foreign currency to provide relief. I'll take it again, this time with some numbers. Now, if Glo Nigeria, maybe Glo Ghana, had an accessible profit in Ghana of 1 million naira, and the tax rate for Ghana is 20%. That would mean that 200,000 would have been taken for tax. They will bring this 1 million naira again to Nigeria, and Nigeria is going to tax it 30%, which is 300,000. So you see, if you add the 200,000 suffered in Ghana, 300,000 suffered in Nigeria, it's supposed to be 500. Why would they pay 50%? Now, in Nigeria, they are going to provide relief because this is a Nigerian company. Now, what is the relief? They're going to look at the 20% of Ghana and compare with the 30% of Nigeria. The rate is what they are looking at. 20% is smaller than 30%. And so the relief that Glo Ghana will enjoy in Nigeria will be 20% of 1 million, which is 200,000. So what happens is this: Nigeria will charge 300,000 tax payable, less relief, 200,000 tax payable in Nigeria will be 100,000. And so you see, they have paid 200,000 in Ghana, and now they are paying 100,000 in Nigeria. So when you add these two taxes together, they are paying nothing more than 300,000 total. So you see, the tax that they are going to suffer in Nigeria can never be more than Nigerian tax. And if you look at it now, if you look at the bigger tax and the smaller tax, the sum of the two countries' tax is going to give you the bigger tax. So you see 200 plus 100 gives you 300. And how much was charged in Nigeria? 300 initially. So you see, they will always pay the higher of the two countries' tax. Now, let me twist things a little bit. Suppose that Ghana is charging a tax of 35%. And so they've paid 350,000 naira in Ghana. They came to Nigeria, and Nigeria is charging 300,000. That's 30%. How much relief are they going to give? They're going to compare 35% and 30%. And they will say 30% is smaller. So they will say 30% of 1 million, which is 300,000. So what Nigeria will do is this: tax chargeable to Nigeria, 300,000. Tax, double taxation relief, 300,000. How much are they going to pay? 0 naira. So you see, 0 naira plus 350 they have already paid is 350. So we say when you add the two taxes together, it will give you the higher of the two taxes. And that's one principle. The second one is you cannot get a relief higher than Nigerian tax. So you see, you got that 350 from somewhere. You cannot be expecting to get 350 relief in Nigeria when you are bringing a tax of 300. The best you can get is to get all your tax in Nigeria taken as relief. Now that's the benefit of double taxation agreements. And so you see Nigeria and China, Nigeria and UK, Nigeria and several countries are going into agreement to get double taxation agreements so that people, Nigerian business people earning foreign currency will thrive. They will succeed in their business. They will improve Nigerian economy. They will go into more foreign businesses. Now that's one part. The second part, which is the flip side, is where there is no agreement. Now, when there is no agreement, we look at it like when a partnership business has no agreement. And, when there is no agreement between two people coming to do business and something happens. So how will they be able to share profits? How will they be able to deal with things? That's where some sensible form of equitable sharing comes into play. So the equitable sharing formula comes into play. In section 33, subsection 1 of the Company Income Tax Act, it's stated that Nigerian companies that are domiciled outside, if there is a no double taxation agreement, well, that doesn't mean they are doomed to pay double tax. They are going to get some relief, but their relief is not going to be as big as when they have a double taxation agreement. So what happens is that they pay the tax in Ghana, let's say 20% in Ghana, and they come to Nigeria. When they come to Nigeria, Nigeria is going to charge them 30%, right? 300,000. They have already paid 200,000 to Ghana. But when they check, do you have agreement? No. So we're not going to give you 200,000 as relief. We're going to say, let's compare the rates of tax you paid in Ghana and half of Nigerian tax. So you see, they have gone half. Instead of comparing with the full Nigerian tax, they are going half of Nigerian tax rates. And so they now look at 15% versus 20%. Previously, when there is a double taxation agreement, we are looking at 20% versus 30%. But now we are looking at 20% versus 15%. Whichever is smaller, that is what they will use. So 15% is obviously smaller. And so they would look at 15% of 1 million, which is 150,000. So they're going to grant you out of instead of 200, when there's double taxation agreement, you're going to be granted 150,000 from the 300 you are supposed to be charged to tax. So you're going to pay 150 plus 200, which gives you 350. So you see, now, if, assuming Ghana is charging them tax at the rate of 10%, okay? If Ghana is charging them at the rate of 10%, they are going to look at the 10% versus 15% of Nigeria. And so they are going to use the smaller of the two. So it means the 100,000 they paid is what they will relieve. So the law says if the Commonwealth rate, that's the name they give foreign tax when there is no double taxation agreement, they call it Commonwealth rate. If it does not exceed 1/2 of Nigerian tax rates, that means if it is either less than 15% or up to 15% and nothing more, then we will use the Commonwealth tax rate, which is obviously either smaller or equal to half of Nigerian rates. But in the case when the Commonwealth tax rate is higher or exceeds 1/2 of Nigerian tax rate, then will fall back to 1/2 of Nigerian tax rate. So you see, use figures, 20% versus 15, or maybe perhaps 12 or 10% versus 15. Take the lower one. Now that's for what you will be seeing in the exam. Now, there is a provision of section 33, subsection 2, which is for non-Nigerian companies. And it says that if the Commonwealth rate of tax does not exceed the Nigerian tax rate. So now we're not looking at, this is for a non-Nigerian company, let's say MTN. Now, MTN Nigeria, we look at Nigerian tax rates with Ghana's tax rates. And they say if the Ghana's tax rate, or South Africa's tax rate rather, is either lower or equal to Nigerian tax rates. Let's say Nigeria is 30%, South Africa is 25%, or maybe South Africa is 26%. What are they going to do? They are going to use half of South Africa's rate. Let's look at it again. They will bring the South Africa rate, they will bring Nigerian rate, and they will compare. As long as the South African rate is not higher than Nigerian rate, if they are equal, no problem. If it is lower than Nigerian rate, no problem. They will still slash down South Africa's tax rate again to half, and that is what they will use as relief. So the formula says if the Commonwealth rate of tax does not exceed the Nigerian tax rate, the tax relief will be 1/2 of the Commonwealth tax rate. Now, assuming they now check and they find out that the Commonwealth tax rate is higher than Nigerian tax rate. Let's say the Commonwealth tax rate is 35%. Maybe that is South Africa is 35%. Nigeria is 30%. What will happen? They will not go by half again. What they will do is, yes, they will still go to half. They will now look at 35%. Half of 35% is how much? Or let's say 36%. 18 is going to be 18. 18 is 36, yes. So if it's 36%, they will divide it into 2 and say half is 18%. It is that half they will use with Nigerian tax rate. They will say, okay, Nigerian tax rate is 30%, and they'll say 30% minus half of South Africa's rate. So 30 minus 18 is going to give you 12%. That is what they will use. So the law says if the Commonwealth rate of tax exceeds the Nigerian tax rate, the amount by which the Nigerian rate exceeds 1/2 of the Commonwealth rate of tax will be the double taxation relief. Now, most times this doesn't come out in your exam because normally these kind of things, when it happens to like telecommunication and airline businesses, we use what is called the special business model. So section 33, subsection 1 is for Nigerian companies that have no double taxation agreement. Section 34 and 35 is for Nigerian companies that have double taxation agreement. So it's only for Nigerian companies. So what you should look for in a question that has to do with double taxation is this. 1, check if it is wholly Nigerian company. That's one thing you should check. It has passed the first tick. 2, check where it is domiciled. It must not domicile in Nigeria. That means there is a company that is part of it that is domiciled outside. It is that outside own that you are now subjecting to double tax. 3, look for the accessible profits and the chargeable profit. So what is the accessible profit? Accessible profit is when you get your adjusted your net profit, you adjust it to get adjusted profit or to get accessible profit. Then you remove capital allowance to get taxable profit. It is taxable profit now you should look at. Then, after looking at taxable profits, look at tax rates. How do you know the tax rates? You look at the foreign tax that was paid. Use it to compare with the taxable profit to find what is the rate. So if I say that I have paid 20,000 naira, 200,000 naira as tax in South Africa, and my taxable profit is 1 million, what I'll simply do, I will say 200,000 tax paid divided by 1 million taxable profits times 100 to give me 20%. This is because 20% of 1 million will give me 200,000. So that is how you do to get the foreign tax rates. Of course, Nigerian tax rate is always 30%. You now compare. Then you look for which rule that applies. You now check, do they have double taxation agreements? If they have, then you look for the smaller rate and multiply the foreign taxable profits. if they do not have the double taxation agreement, then you look for the Commonwealth principle that you will apply. So that's it. The impact on double taxation is it avoid double tax. At least to an extent, you have avoided double tax. Then there is a clarifying of rights of each state to tax each citizen. It encourages economic cooperation between states. It prevents tax evasion and the lowering of compliance costs. Okay, now that we've seen that, let's take the next moment to look at exercise 3.1. The question reads, Salim Consultant Limited, which was incorporated in 2012, is a firm of corporate advisors resident in Nigeria. So you see the word, I highlighted it. In the exam, you may not get the luxury of getting it highlighted. Resident in Nigeria. Now, when they say resident in Nigeria, it is different from domicile in Nigeria. Resident in Nigeria is another way of saying incorporated in Nigeria. It's another way of saying the company is a Nigerian resident. You know, in residency, there is individual residence. When we say an individual is resident in Nigeria, if he stays in Nigeria for more than 183 days, and a non-resident Nigeria will be one that does not stay up to 183 days. You know those drills. But when it comes to companies, now companies is a different person on its own. So we are looking at not business ventures or enterprise. We are looking at companies which have a legal standing on its own. Now, this company, if it is registered in Nigeria, got its RUC number from Corporate Affairs Commission of Nigeria, then that company is resident in Nigeria. Even though it has spent 5 years again in Burundi, it is still a Nigerian resident company. So in 2015, it expanded to Burundi to tap into the booming business opportunities in that country. The directors have heard of double taxation agreements with the attendant benefits, even though the company has never been a beneficiary. The directors, being highly educative executives, have tried on their own to read and understand the concept of double taxation and the attendant relief, all to no avail. Below is the summary of the income statement for the year ended December 31st, 2016. So, you know, we still know it is preceding year basis. That is normally the tax principle for many countries, preceding year basis. So that would mean that this is 2017 year of assessment that has this income statement. Now, can you see Nigeria? Can you see Burundi? Can you see total? Now, Burundi does not use Naira. Why are we putting Naira there? Now, you know, when you are preparing a consolidated account, you have to translate. If you have been taught group accounting, there will be foreign branch. You have to translate the foreign currency, the foreign statement into Nigerian statement. If it's a Nigerian company. So Burundi would have done that, and everything they are giving you here is the Nigerian equivalent. And so there's going to be a currency exchange. So maybe at one time, the currency is fluctuating. So they may have loss, gain, loss, gain, loss, gain throughout the period. And in the end, they will have either a resultant loss or profit, whichever is going to happen. Now, because this is a Nigerian resident company, Nigeria is taxing the worldwide income from that company. So wherever you see the total being consolidated, it means it is consolidated in Nigeria, and it also represents Nigeria. So I can as well call it Nigeria, Burundi, Nigeria. That's it. So the total is consolidated in Nigeria. So look at the gross advisory fees, other income, deduct expenses. We have deal execution expenses, office rent, depreciation, loss on sale of non-current assets, foreign exchange loss provision. This is because of the fluctuation in currency. So they will have foreign exchange, either gain or loss. Okay. Other operating expenses and net operating profits. So these are their profits. Then we are given additional information. We were told that the sum of 2,130,000 was paid to the Burundi Tax Authority for the year. So we were not shown how Burundi did their assessable profit and all that. We were not told how they calculate their capital allowance and now resulted to tax. We don't care for now. What we care about is how much did you pay in Burundi? This is this amount. Now, what is your capital allowance allowed in Burundi? 4,800,000. Now, these are the two things we just need from the Burundi government. How much is the tax? How much is your capital allowance? That's fine. They might show working, they might not show working. It's not important. That news is important. Now, Nigeria capital allowance is claimed in Nigeria is 7,800,000. We were not told how we derived it, but that's not important in this topic. Now, the next thing we are told is that other income of 960 is from the sale of non-current assets. So if you look at other income, you see 960 there. They are telling you is from the sale of non-current assets. And they said while 1,800,000, you see under Burundi we have 1,800,000 is gain from disposal of securities. We are now asked, as a tax practitioner, compute the double tax credit. When they say double tax credit, is the double taxation relief. It's either called relief or credit or allowance. Double tax credit, double tax relief, double tax allowance, claimable by the company. Now, the key word now again is assuming there is a double taxation agreement. Underline it. Now, if there is a double taxation agreement, the question must state it. It must state it. If that words are missing, you can safely assume that it does not have a double taxation agreement. So when these words, that assuming there is no double tax, assuming there is a double taxation agreement, if it is not stated, you can assume there is no double taxation agreement. Also, they might state that assuming there is no double taxation agreement. So these are the two ways you can know if there are no double taxation agreements. They might state it, there is no agreement, or they may be silent about it. But they can never be silent if there is an agreement. So that's one thing you should know when you are doing double taxation agreement, that they will never be silent about the agreement status. So two things you've identified: it is a Nigerian company. Second thing, you've identified there is a double taxation agreement. what do you do? Now look at the solution profile here. The solution here says you have your statement here. You bring your net operating profit. That net operating profit is what the consolidated account is showing. You know, the accountant's, the financial accountant's profit is different from the taxation profit. The taxman's profit is different from the financial accountant's profit. The financial accountant's profit is called net profit. The taxman's profit is called taxable profit. So there should be a way for you to reconcile or convert the financial accountant's tax to the taxation, the taxman tax. So how do we do it? What we do is we look at our net profit and ask ourselves, from the income side, are there income that you have added to your statement which are not supposed to be there, which are not taxable? If they are not supposed to be taxable, you remove them. Then you look again. Are there some income that is supposed to be taxed that was missing in the statement that you have not entered? Then bring it in. So it means after your net operating profit, you'll add taxable income, not taxable income omitted. Taxable income omitted. So those ones that were omitted from the statement, you will see them in the additional information. They will say, it has not been recognized. You recognize it. Then you less non-taxable income. Now in this question, we have two non-taxable income. The first one is the sale of non-current assets. Now, sale of non-current assets is your fixed assets. You know, if your fixed assets expenditure cannot qualify as your operational expenses, then why should the sale of current assets, of non-current assets, be part of it? In fact, the sale of non-current assets is not an operational result, but it's a financial result. It's a financial result. So this is something that should be in your statement of financial position. It's a financial item, not an operational item. And so you do not tax the sales from current assets. So what happens? What you now do is you deduct the 960 that was included in the statement. You deduct it. So you deduct it from the Nigerian side, you deduct it from the total side. Now the gain you got from the disposal of your securities was for when you bought a security, you became like a part owner. You invested in a company, and so that is like this sales from disposal of securities is like investment income. It's like gains from investment. It gets investment activity. I don't know if you've done cash flow statements. We have cash flow from operation, cash flow from financing, cash flow from investment and financing. So you see, the gains from disposal is not part of your operations. Disposal of securities. Securities is you bought a security, you're not selling it, you are getting back the money. It's not supposed to be your operational profit. So for Burundi, you're going to remove the 1/8 and you're going to remove it from the total. So when you do that, your profits will now reduce from 16 million something to 15 million. And look at the grand total has gone down from 25,115,000 to 22,395,000. Now that's for the income side. We go to the expenses. We look at those expenses that has been deducted previously in the statement. Did they do it well? Are there some expenses that are disallowed by tax law, but the financial accountant has allowed it by financial accounting principle? So if he has allowed it and deducted it, the taxman will say, no, add it back. Classic example is depreciation. The taxman does not like you using depreciation. He gives you capital allowance. So you have to add back any depreciation that you've deducted. So you look at the depreciation that was said in the additional information, 5,100. Okay, depreciation was not in the additional information. It was in the body of the question. 5,100,000, 2,700,000 for Burundi, everything 7,800,000. Fine, you add it back. Now, there is sale of non-current assets. So can you see that when if we have to deduct sale from non-current assets from income, simple logic says also that loss you made from non-current asset doesn't concern operation. You also have to add it back. So you add it back from, forget that second bracket that you saw there. There's not supposed to be bracket. You add it back. So you see, you have deducted it before. It doesn't concern operation. Reinstate it so that your profit will increase. Okay? Now, we are going to add back foreign tax suffered. Now, mind you, some people will be asking, is tax suffered a disallowable expense? No, it is not a disallowable expense. Then why are we adding it back? We want to add it back because we want to get our taxable profits. It is from our taxable profits that we pay tax. So we want to see how much was our taxable profit before the tax was paid. That is the reason why we are adding back the tax suffered. So when we add our tax suffered, we'll get our accessible profits. Mind you, tax is an allowable expenses, but you have to look for the taxable profit first. So an accessible profit, and there is no way you can get it without adding back your tax. So we add our tax back because later we'll remove it after we've gotten our accessible profit and our taxable profit. So that's the reason we are adding the tax back, and it's the foreign tax because Nigeria has not charged tax. It's only Burundi that have charged tax. We'll add it back. And so our accessible profit is giving us 2775, 12,075, 32,850 total. Okay? Now that would be your accessible profit. Now the capital allowance, you're going to less capital allowance. So the capital allowance you're lessing is 7.8 for Nigeria that was given. Burundi was 4,800,000. So that's it is important to know that these are given to you in the additional information. So it has not affected the account. So we are going to remove the capital allowances. So When we remove capital allowance from assessable profit, your tax knowledge shows you that it's going to give you your taxable profit. We call it taxable profit, we call it chargeable profit, we call it total profit. And you can see on the screen here that Nigeria alone is having 12,975,000. Burundi alone is having 7,275,000. And the total, which is claimable in Nigeria, is 20,250. Now look at the tax paid in Burundi. Can you see now I'm bringing back the 2,130,000? That is the tax paid. Normally, that is the tax paid. Now, that side of Nigeria alone, you don't do it. You don't do Nigeria alone. Now, let's assume that we have 10 branches and Nigeria is the parent. Nigeria and 9 other countries. You are going to do the tax paid in all the 9, but you will not do for Nigeria. This is because that total column is Nigeria. So everything for Nigeria ends, Nigeria alone ends at total profits. Now look at the tax paid in Burundi. That was the tax given in the question. Now, how do we know the percentage? So you see why we have to look for the taxable profits, and you see why we had to add back the foreign tax so that we can get our taxable profits. Now you can see that your foreign tax paid divided by your taxable profit, foreign taxable profits, multiplied by 100 is going to give you the percentage of tax, which is 29.28. So if you look at 29.28 approximately multiplied by 7,275,000, you're going to get that 2,130,000 that was the tax paid. So that's the technique you use in getting your percentage of tax paid in Burundi. Now look at the tax paid in Nigeria. It's going to be 30%, right? Fine. That will mean that we're going to look for 30% of what? Not 12,975, but the total, 20,250. And that gives you 6,075,000. Now, since the company is a Nigerian company, it is Nigeria that is granting the double taxation relief or credit. And how much is the relief? The relief, I told you before, if double taxation agreement exists, you are going to be comparing Burundi's tax rate. So that means you need to know the tax rates as shown here, 29.28 versus 30% of Nigeria, 30%. Which one is smaller? 29.28 is smaller. And so we'll say 29.28% of the foreign taxable profits. That will be your tax credit. So that amount you paid in Burundi is the same amount that is your tax relief, 2,130,000. That is what the examiner is telling you. But it did not just end it there. Look for the final tax payable in Nigeria. It's going to give you 6,075,000 minus 2,130,000. It's going to give you 3,945,000. So you see, that is the final tax payable in Nigeria. Now, if I ask you to do something, if you add 3,945,000 paid in Nigeria with 2,130,000 paid in Burundi, the total will give you what was supposed to be payable in Nigeria, 6,075,000. So that's it. So from what you see here, when there is a double taxation agreement between two countries, the smaller tax paid the smaller tax paid within the two countries become the tax relief. The smaller tax paid becomes the tax relief. So do you see that we paid 2,130,000 in Burundi and 2,130,000 is the relief? Now, assuming Nigeria is 2 million and Burundi is 2,130,000, that 2 million in Nigeria will be the relief. So you see the smaller tax between the two countries becomes the relief. That's it. Okay? So we've done the first part of the question. Now let's go to a situation here. In the second part of the question, we are told to, the second question, we are told to briefly explain what you know about double taxation treaty. Okay, a double taxation treaty, whenever a foreign currency is aimed and repatriated to the home country, there are tax implications involved. And this implies that the foreign income earner pays a tax, both in his place, his business is domiciled in the foreign land, and in his home country. That means he's paying a double tax. When Nigeria have a double taxation treaty with any country, there is a relief that a foreign income earner enjoys. The double taxation relief is granted in accordance with the provision of the double taxation agreement. Hence, the relief enjoyed will be the lower of the local tax paid or payable and the foreign tax paid or payable. On the other hand, if there is no double taxation treaty and thus no double taxation agreement exists, then there is an equitable way of preventing the foreign income earner from paying too much tax. The income tax relief will depend on whether the company is incorporated in Nigeria, called a Nigerian company, or a resident company, or the company is incorporated outside Nigeria, called a foreign currency company, and that is called the Commonwealth rule. And it holds that for a Nigerian company, if the Commonwealth rate of tax does not exceed 1/2 of Nigerian tax rates, the double taxation relief will be at the Commonwealth tax rate. If, on the other hand, the Commonwealth tax rate exceeds 1/2 of the Nigerian tax rate, then the double taxation relief will be 1/2 of the Nigerian tax rate. Now, coming to the non-Nigerian company, if the Commonwealth rate of tax does not exceed Nigerian rate of tax, the double taxation relief will be 1/2 of the Commonwealth tax rate. If, on the other hand, the Commonwealth tax rate exceeds the Nigerian tax rate, the double taxation relief will be the amount by which the Nigerian rate of tax exceeds 1/2 of the Commonwealth tax rate. Now, this is the answer to the Part A question. That's the answer to the Part A question. So let's look at Part B. Part B says John Okafor and Company Limited. So you see, it's a limited liability company. Assuming the word limited is not there, they wrote John and Okafor and Co. It's a business name. So it's going to be treated as a person, not as a legal entity. So this is a company. It's an accounting firm based in Lagos. It was so because you see based in Lagos doesn't tell you anything. It was incorporated in Nigeria. That's what we are looking for now. It was incorporated in Nigeria. So you underline it, wholly Nigerian company. In the year 2000. In 2007, the company extended its operations to London. So now there is a foreign branch. It means now that it's a Nigerian company extending its tentacles to London. So there's going to be a consolidation between Nigeria and London. That consolidated account belongs to Nigeria. The results of the business operation for the year ended 31st December 2007 for both Lagos and London transactions were as follows. Now you see the consultancy fees, the professional fees, these are all allowable income for an accounting firm. Now look at the total income. Now look at the expenses. We have staff salary. Yes, it's okay. Electricity and rates. Yes, it's okay. Motor vehicle maintenance. Yes, it's okay. Depreciation of assets. No, it's not okay. Other administrative expenses. It might be okay, it might not. Additional information should tell us. Bank charges and interest charges paid, approved. Foreign tax suffered. Of course, it's supposed to be approved, but you know, foreign tax will be added back because we want to look for accessible profit and taxable profit. Now they said other miscellaneous expenses allowable. They said it's allowable, we believe them. Total expenditure, look at your net profit. Required. If the capital allowance agreed with FIROS was 1,450,000, they only gave us one capital allowance. So where do you assume it to be? Nigeria. They told you Nigeria, FIROS. Compute the double taxation relief applicable to the company. So where is the London? Perhaps there was no capital allowance for London. Maybe they didn't have any assets in London that will be charged capital allowance. Or who knows? They didn't tell us anything about London capital allowance, so we assume zero. Now, compute the double taxation relief applicable to the company and the final tax liability payable if, number one, there exists a double taxation agreement between Nigeria and London. So they said there is a taxation agreement. So we are going to solve that first part the way we solve the first example. Then they said no double taxation exists, but both countries are in the Commonwealth group. Then we are going to solve this second part using the Commonwealth principle. And when we do that, that will bring an end to this topic because this question alone is a sample of how double taxation agreement and questions are going to be like. Okay, so we're going to look at the solution now. Hold on. Okay, good. Now, if you look at the solution, what I've done here is I bring the Nigerian office, which is in Lagos. I bring the total, the London, and do you see total there? You see Nigeria. I brought the net profits that was given to you, the taxation profits. Now I want to convert it to the taxman's profits. So I bring the net profits. Now I am adding back because the profits that were given to us, the income that was given to us, were all allowable income, taxable income. So nothing happened. But the expenditures have some issues. We're going to add back some expenditures that were deducted. For example, depreciation of assets. We are going to add it because it was deducted. So we have added them back. Now look at the foreign tax suffered. The reason why we are adding it because we want to get back our taxable profit, of course, accessible profit before taxable profits. And so we add them back, and we've gotten a figure for our accessible profits, 720, 4928, and 5648,000. Now look at capital allowance. There is nothing to put under Lagos because they didn't tell us, they didn't split how much Nigeria paid and how much London paid. So everything ends at accessible profit for Lagos. I will not go and put 1.450 for Lagos alone, because this 1.450 is not just Lagos, is the whole assets of the companies that they give. FRS say the capital allowance is 1,450,000. So I put it under total. And so London office is still giving us 4,928,928, while the whole total, so you see, it is not even balanced. It is because of that capital allowance. So Nigeria is, for London, is this one. Nigeria is 4,198,000. So that's going to how it's going to be. Now look at the foreign tax. How do we get the tax rates? We look at the tax we suffered, 1,510,000, all over 4,928,000 multiplied by 100. We have 30,000, 30.64%. Now that is higher than the Nigerian tax rate. Now, because it is higher than the Nigerian tax rate, whenever there is a double taxation agreement, we use the lower of the rates. And so what do? We will now use 30% to find the relief. So we're going to say 30% of the total profit of London. That's going to give me 1,259,400. So that is going to be the relief that is claimable. That's the relief that is claimable. Now, the rule to apply, it says here, if a double taxation agreement exists and the foreign tax rate is greater than the Nigerian tax rate, which is clearly seen, then the double taxation relief claimable will be charged at the Nigerian tax rate. So it is clear that 30% is lower than 30.64. So we're going to use 30%, which done that. Now we're going to use 30% of the foreign, which is 1,259,400. So if you look at the tax liability, look at the tax liability. For tax liability, we'll bring our profits, our total profit from the previous page. For Nigeria, which is presented as total, and for London. What is the tax payable? Look at what we've calculated for what we got from London given to us. And look at 30% of 4,198,000 Nigeria gives you 1,259,400. We did that in the previous page. Now, what is going to be the relief? And we said our relief is going to be calculated using 30% of the foreign income. So 30% of 4,928,000 is going to give me 1,478,400. So you see, that 1,478,000, that is what you are supposed to enjoy as a relief. but there is a restriction. Your relief can never be greater than Nigerian tax. In other words, Nigeria is not going to give you a refund. Because if we were to put this 1,478,000, it means Nigeria is supposed to give them a refund. No, Nigeria will not give you a refund. What Nigeria will do is they will say, all right, your relief is higher than our tax. That will mean that our tax is going to be used for relief as much as possible. So you see, you are not paying any tax in Nigeria anymore. So instead of using 1,478,400, we are now using Nigerian tax at the smaller 1,259,400. Even though we've said before that it's 30% that we are supposed to use, we are still using something lesser than 30%. So we are using 30% of foreign total profit. Instead of that, we are now using 30% of Nigerian profits. And so your final tax liability is just the foreign tax you've paid, because Nigeria is zero. So you see, from the computation above here, the company is only paying the foreign tax. Now, in the situation whereby there is no double taxation agreement, what do we do? Okay, we'll do the same thing we did here, and we'll get the same total profit, accessible profit, and same total profit. We are at the same situation. We look for our foreign tax. In fact, in exam, you don't need to repeat all of this. The exam, what you just need to do is just to recall your total profit from the previous solution, the total profits from the previous solution. Okay, you recall the tax rates of the previous solution, 30.64. You recall Nigerian tax rate, 30%. But you still need to find if half of Nigerian tax rate, because this is a Nigerian company. You now look for half of Nigerian tax rate. You ask yourself, which rule are we applying? We're going to apply the rule that's applicable to Nigerian company. The rule is, if the double taxation agreement does not exist and the foreign tax rate, known now as the Commonwealth rate, is greater than half of Nigerian tax rates, then the double taxation relief claimable will be charged at half of Nigerian tax rates. So that means we are going to use 15%. We are going to use 15% of the foreign tax profits, taxable profits. So 15% of 4,928,000 is going to give me 793,200. So we come back to the drawing table. London and Nigeria bring their taxable profits, bring the tax payable for London, find 30% of Nigeria, just like we did before. Nothing changes. The only slight changes is the rates at which we are using for the relief. The first one there, we are using 30,000. We are using how much? We use 30%. But now we are going to be using 15. Sorry, I put 30 there, but it's 15. Please use your biro to write 15. So 15% of that figure gives you 739,200. So you see, 739,200 is what is deducted from Nigerians' profits, from Nigerians' tax payable. And so when you deduct it, you have 520,200. Don't go and add the London tax payable and Nigerian tax payable and expect it to see it as the total tax payable. No, this is because there is no double taxation agreement. So from the above, the total tax that the company is paying is 2,030,200. That is the total tax they are paying, comprising of that of London and that paid in Nigeria. So this is how we will treat double taxation principles. So you see, when it comes to double taxation, normally we usually say residents, non-residents, and double taxation. They normally go hand in hand. You know, a non-resident person is someone who is not domiciled in Nigeria, domiciled outside. And so that person, even if he earns foreign income outside, it's not going to be taxed in Nigeria. But when he comes to Nigeria if he comes to Nigeria and become a Nigerian citizen, Nigerian resident, but he goes outside to make foreign income and brings it to Nigeria, he's doing trade in Nigeria, he's doing trading. Even though he's a non-resident, he's not spending up to 183 days in Nigeria, and he's doing trading. No, they will tax you because of the virtue of the fact you are doing trading. If it is just employment income, you won't be taxed as long as you're not a resident. But once you start doing trading, you will be taxed. And because you are doing international trading, they will tax you there, foreign company, foreign currency. Now, because you don't stay up to 183 days here, you stayed more there, they're going to tax you there, and you are still bringing it to Nigeria. By the fact that you are doing the trade in Nigeria, they are going to tax you. So you apply the double taxation principle. Now, I want to state too that for individual, it is domiciliary, not origin, that determines your residency. It is domiciliary, not origin. Okay, when I say it is residence, rather, not origin, that determines whether you are a resident or non-resident. Yes, it's domiciliary. Okay. Now, if let me give an example. This Nigerian player, Mikel Obi, Shebi is domiciled in Russia and is not resident in Nigeria. But because he is from, I think, Delta State in Nigeria, his state of origin doesn't matter. But is he in Nigeria for up to 183 days? No. And so his income is not taxed in Nigeria. But if he starts doing business in Nigeria, he will be taxed. Now look at, if Nigeria now have a foreign coach, so by way of origin, nationality, he is not a Nigerian. But because he earns his income in Nigeria, he stays here for more than 183 days, he's being taxed here in Nigeria. So you see, nationality doesn't play a role, but your domiciliary, your residence. But for company, we say that your incorporation determines your residence. So if Nigeria, Glow Nigeria, incorporated in Nigeria, if it goes to open a branch in Ghana, it is just going to merely register that incorporated name in Ghana. It's not going to incorporate it again. So MTN is getting a Nigerian registration, but it's not incorporated in Nigeria. So even if you see Arusi number in their cards and all that, they are not incorporated in Nigeria. They are incorporated in South Africa. Same with ShopRite and all that. So that's it. So today our class has been double taxation, and the time we spent with it is quite handful. So I want you to use the remaining time to go through it, go through some of the past question papers, and try to solve as many foreign taxation problems as possible. Like I promise, if I clear my space on my phone, I'm going to send you a voice note again on double taxation. It is based on if there is space on my phone, because my phone is telling me it's dangerously low. There's space I'm going to send so that you can also tap and get more knowledge about this. I want you to solve some questions, send it to the WhatsApp group for me to see it. If possible, correct some of your mistakes. So next week, when we'll have our next class, we're going to take another important topic that you will see in the exam, and we're going to trash it, and we'll do a good job about that. Thank you so much for coming to class, and have a wonderful day. Somebody is saying, I was told that if foreign tax suffered was not included in the statement, there was no need putting it back when computing accessible profit. Yes, if foreign tax is not in the statement, it means it has not been paid. If foreign tax is not in the statement, it means it has not been paid. So there's no need adding it back when it has not been paid. They will only tell you in the additional information that the foreign tax payable, that means they would have calculated it and give you how much is payable. So there must be something about foreign tax in the question. It might be in the body of the statement, it might be in the additional information. If it is only in the additional information and not in the body, don't add it back because it has not suffered tax. All you need to do is take that tax in the additional information and look for the rate like we did here. Foreign tax suffered or payable divided by total foreign profit times 100%. Use it to get the rate. That's why they will give you that tax payable, and that is what should obtain. But once you see it in the statement, fine, it has suffered tax. Sensible thing, add it back. So thank you for that point. That's a very sensible point you brought in here. So get more questions like this and bring it to the WhatsApp group and let's trash it. If you are finding it difficult to solve some problems from this topic, let's discuss it so that we will get your problems sorted out. Thank you once again for coming to class. So in the absence of further questions, I want us to call it quits today. See you again next week. Good night. Okay, somebody is asking another question. Okay, he said thank you for the explanation. Thank you so much too. Thank you so much. Thank you so much. All right, so let's call it the day now. Somebody said, I miss your PowerPoint presentation. Okay, are you not seeing my screen? You are not seeing my screen. I believe you saw my screen. Oh. Everybody was seeing my screen and they were seeing me. Okay. Thank you so much.